It's Monday, my favorite day of the week. Is it yours? I like to say TGIM. Thank God it's Monday. I know other people say TGIF. Don't know what's wrong with those guys. I mean, don't you want to love Monday? So today I'm going to just talk about some research that I'm working on in relation to inflation, and particularly looking at the US and asking the question about inflation. So I'm going to just share my screen and I'm going to go through a presentation here. So let's take a look at it. It should take about 10 minutes, I'd say. So for investing, inflation is critical. So let's look at inflation. So here we can see, I'm going to hide this. The question that I'm going to ask today is, will the US face inflation or deflation? So now, my question is America more likely to experience inflation or deflation over the next 12 months? So I asked this question on Twitter to my followers, and I basically said, you've got to choose one or the other. And so from that, the answers that I got after all the results came in was 50-50. So this basically shows that really it's something that it's really a toss-up. There's a lot of pros and cons. So why is it important to think about US inflation? Well, it can impact the value of the dollar, which could impact both people in America as well as people investing in the dollar. It can impact interest rates, and of course this impacts the price of bonds and stocks. And the relationship between inflation and money supply growth seems to have broken down, with tons of money printing, but yet no inflation, talking about since the 2008 crisis. So what I want to talk briefly about is I'm going to talk about factors. And what I'm going to do is to say that there's many factors that can impact inflation. So first, I'm going to list out all the factors. Now, because I want to keep this somewhat short so we can get through it, after that, I'm going to consider each factor and then try to figure out that factor's impact and direction, which is something we'll do in another presentation. So let's get into it for now. I'm going to look at it like this. I'm going to say the factors and their impact on inflation. So in the middle is going to be the factor, and whether it raises inflation or lowers inflation, depending. So let's look at the first factor, globalization. Now, when there is more globalization, products and services are produced at lower and lower prices than would normally be produced in the US. So we can see that would lower the price of goods and services, hence lower inflation. So more globalization would lower inflation, less globalization would raise inflation. All right, let's look at the next factor. Now, you may ask the question, well, where are we on this? Well, we can see that there's been a lot of political rhetoric coming out of the US and some action that's moving us towards less globalization, which means that less products will be produced out of China for the US market, and maybe they'll come out of Mexico or other markets as well as being produced in the US. Generally, this is going to raise the price of goods and services, and that's going to raise inflation. Now, what about government regulations? It's crazy. You go into any shop now and they've got someone standing there with a gun to your head. Well, not a real gun, but a temperature gun. And also you've got all kinds of regulations in a restaurant, 50% capacity. People can't sit next to each other. At companies and businesses, we may have distancing that's got to happen in their offices. And the result of that is that more government regulations, particularly related to COVID, will raise inflation, meaning more costs to produce the goods and services. All right, next one, government spending. Now, when the government spends more than what its tax intake is, it is injecting money into the system. And so that increases the money supply. Therefore, more government spending means eventually a rising inflation. So in this case, what we can see is that the US government now is spending massive amounts of money directly into the economy, directly to individuals and businesses. And the result of that is that at some point that will cause inflation. So what about the next one? The Fed expands the money supply. Now, if the Federal Reserve of the US is expanding the money supply, that is going to raise inflation. The Fed hasn't been contracting the money supply in years. They tried to contract the money supply a little bit in the past, but they couldn't deal with the consequences of that, which is higher interest rates. Now, there has been some debate about whether Fed intervention through QE is actually causing an increase in the money supply, or is in fact not. That's a topic that I'll talk a little bit more about in my next presentation. But generally, if the banks don't lend on the money that has been injected into them from the Fed, then you could argue that it's actually not expanding the money supply. Of course, the other thing you could argue is that if the Fed has a mechanism, as it does now, an SPV, basically a special purpose vehicle that they have, and an ability to buy bonds of companies, you could argue that the intervention in that case could potentially increase the money supply. So at this point, I think we can say that the Fed expands money supply is more, and therefore it's going to have an impact on inflation. Now, what about the supply of goods and services? I think you can argue that supply chains have actually been damaged and have been shut down in some places. So the actual supply of goods and services is less. So it's more inflationary. What about demand for goods and services? Well, the demand, when everybody's staying home and people aren't spending, you can say that, let's say, luxury goods and things like that, things that you would get when you go to the shopping mall, a new outfit, whatever, definitely there's less demand for goods and services. And so if that's the case, it should lower inflation because of the situation that we're in. Now, what about the aging population? Well, right now, the population is getting older, and the result of that is that there's less demand for consumer goods and items like that. Tends to be that an aging population spends less. So that is deflationary or lowers inflation. How about technology? Well, anytime that we adopt technology like this restreaming technology, rather than having to spend the money to get everybody together, using different technology tends to cause us, if we use more technology, it causes inflation to fall. Why? Because we are cutting the cost of making the product, and that means that the companies can cut the price of products. Unemployment. Now, unemployment is massive in the US right now, and the result of that is that there is more, if there's more unemployment, more people don't have a job, it is deflationary, or it lowers the inflation of the economy. And the result of that, of course, goes back to the demand for goods and services. It's related to that. But basically, also, it's about wages. If employees are losing their jobs or companies have less need for different employees, the end result is that the employees lose bargaining power. Could you imagine going to your boss today and trying to get a raise? Very hard to do. So the next thing is the demand for the dollar. Now, when demand for the dollar is strong, what happens is that the dollar rises in its value. And when the dollar rises in its value, it basically means that the dollar buys more outside of America. Now, imagine that the dollar devalued or it fell significantly because demand for the dollar fell. So if the dollar fell in value, it means that foreign items that it's buying that are being bought by the US are more expensive. And the result of that is what we call imported inflation. So a strong dollar means lower inflation. Right now, we're in a strong dollar environment. Now, some people say that could change, which we'll talk more about that in another stream. Now, let's look at the last one, which is the bank's risk aversion. Now, when the bank's risk aversion is low or less, what happens and what that means is that the banks are willing to pump money into the economy by lending to companies and individuals. The arrival of that money into the system and into the banks, or into the companies and individuals, the arriving of that money basically means that there is going to be an impact on inflation. So a positive impact, meaning inflation will rise. So this gives you some question that I'm trying to answer is, will the US face inflation or deflation? In the next time that I talk tomorrow, I'll be talking about my judgment about where do we lie on these various factors. So if you have any questions about it, feel free to ask in this stream or in my other streams. So I'm going to switch back to this. So really, it's a complex question. And the reality is that there's a complex answer. We've got to go through and look at all the factors to try to understand it. And so if you have any questions, feel free to ask. Now, I do see a question coming in from May. Hi, May. What do you think about stagflation? I think I can see low growth and inflation happening at the same time. Yeah. And also I see a question coming in from John also. So let's address May's question, but if anybody has any questions, feel free to ask. So the question is, are we going to get stagflation? Stagflation is when we have low economic growth and coupled with high inflation. And that was something that happened in the 1970s. And I personally think, May, that there's a high chance that we will get stagflation, because I think that at some point we may see weakness in the dollar. And when we see weakness in the dollar, then basically we'll start to see inflation coming into the economy more than it is right now. And the result of that, though, in a low demand environment is, in fact, stagflation. So yes, I think it's highly likely. The next question that I see coming in from John is, can you suggest an investment during this period? Okay, so now why is it important to determine if we're going to have inflation in the US? Well, generally what you can say is that the problem with inflation, many different problems. If you keep your money at the bank, the value of your money is going down. So you don't want to keep your money at the bank if inflation is rising. The second thing is that rising inflation rate means rising interest rate, because every interest rate has an expectation of inflation embedded in it. So let's look at the 10-year Treasury in the US. I can't remember what the latest is, but maybe it's about 0.5 percentage point right now. That means that people are expecting that there's going to be almost no inflation over the next 10 years. Now, that is what's embedded into that. Now, what would happen if inflation rose faster than what people expected? What would happen is that the price of bonds, the value, the interest rates would have to start to rise. And a rise in interest rates would cause a fall in the price of bonds. The fall in the price of bonds means you would lose money on bonds. So one of the things in an inflationary environment is bonds tend to not be the best investment. Now, I would caution that when we talk about the changes in the price of bonds, it's much less volatile than the price of stocks. So for someone that's a long-term investor, they may be able to take some of that volatility in the bond market and not worry about it too much. So it brings me to the next thing, which is, I say if you have a lot of cash right now is a good time to buy a piece of land. Land is a good physical asset, and that physical asset basically probably isn't going to go up and down that much compared to what we're going to see happening to, let's say, bonds as an example. So real estate and land tend to be a good investment if you're going to an inflationary environment. But, one of the other great investments during an inflationary environment ultimately is equities, stocks. Why? Because the CEOs and the management teams of companies are struggling with rising costs because of inflation into their business. But if demand is not that strong, what that means is that they can't really increase their price. So if that's the case, then what's going to happen is their profit margins are going to get squeezed. Well, if you talk to a corporate management team about a squeeze in their profit margin, they're going to say, we've got to figure out a way to make sure that doesn't happen. So now there are some companies that will be affected pretty heavily when the interest rates, when inflation rises. Maybe if they're dependent on a commodity like oil. The question is, to what extent can they pass through the rises in the inflation? So oil price, as an example, in a refinery, basically they pass a higher oil price directly through into the consumer and into the refineries. So basically the answer to that question is you want to own equities to a certain extent, but the equities that do well in this type of environment are the ones that can pass through the rising costs. And then the final thing is gold, of course, and silver and other commodities or precious metals in this case, particularly precious metals, because these are things that tend to have a stable amount of supply, and therefore people have more reliability on them. So those are some other things. Of course, some people like investing in Bitcoin. It's possible that Bitcoin could be a protection or an inflationary hedge, but given the volatility of Bitcoin, I don't think that you could guarantee that. And if you think about someone like my mother as an example, who really does not need to have the exposure to the US market, if I say, oh, I'll put her into Bitcoin instead of bonds, because maybe bonds will go down because interest rates are going to rise, do you think it's a good idea? Look at the volatility in Bitcoin. So it's hard to say that Bitcoin could be a store of value compared to where gold is or silver. All right. So those are some questions that I've gotten. Jeff's got, does inflation mean for assets like gold? And that's the answer. All right. If you got any other questions, feel free to drop them into the comment section, and I can also reply to them later. But I want to thank you all for attending and listening to my discussion. And I think it's time now to go get some lunch. So have a great day.